Many people in this cycle believe that we should follow the global liquidity index, assuming the crypto market would move in line with global liquidity. However, there is a major flaw in this indicator. The problem is that it includes several liquidity observing tools such as treasury accounts, banks' liquid assets, and the Federal Reserve balance sheet within the index itself. Suppose that the central banks have printed a large amount of the money and our M2 index has risen, but that money has been observed into the RRPs or treasury accounts, and in this case liquidity in the market has actually decreased, and our M2 supply when our M2 supply is high but the net liquidity is going down, reflecting the capital that is no longer available to flow into the risky assets. What we actually should have been analyzing is global M2 net liquidity, which reflects only the real usable liquidity circulating in the system. In other words, this matrix removes all instruments that drain or lock up liquidity and leaving us with a clear picture of the liquidity that can truly follow into the risky assets. This orange chart I added to my Bitcoin chart of this indicator shows that in 2022, when we reached the market top, it quickly rolled over and moved sharply to the downside. And throughout this cycle, we have only seen a brief periods of the minor positive fluctuations here and forming a short-lived higher high and before continuing lower again. In this week, we saw a 25 basis point rate cut, along with the comments from Jerome Powell stating that the Fed plans to conject 40 billion per month in T-bills buybacks. What is the T-bills mean? These are short-term securities with a maturities ranging from 4 weeks to maximum 1 year, and they carry very low yields, and most of the bank actively use these instruments. In reality, this move signals that the Federal Reserve is providing a liquidity to banks and effectively repaying its liabilities to them and easing funding conditions, because we are at the end of the year. And if you take the US net liquidity index, which represent the amount of liquidity circulating in the market, and subtract the total M2, total US M2, and then divide them by US national debt, we arrive this chart, the blue ones. The total US M2 liquidity in circulating in right now is $22.9 trillion, but a large portion of this liquidity is locked right now in the Fed treasury accounts. According to Paul Wednesday's remarks, The Fed plans to inject liquidity into the banking system by buying back short-term T-bills before the end of the year and aiming to ease the pressure from the market's liquidity shortage. Meanwhile, US national debt has reached $38 trillion and creating a mismatch between the total money available and total debt. This tells us how much liquidity actually exists in the system right now relative to the total debt that needs to be serviced. Clearly, even though T-bill buybacks and M2 are increasing, most of this liquidity is locked in banks or treasury accounts, and a large portion of is used to repay debts. As this ratio continues to the decline, the remaining liquidity in the market gravitates toward safer, low-risk assets and leaving a little capital available to flow into the risk markets. Historically, every bull market cycles coincided with the rising US net liquidity and M2 net liquidity. Both of them also trended upward, but in this cycle, both indicators are trending downward, signaling a fundamentally weaker liquidity environments for risky assets. And the worst news of all is Japan's upcoming interest rate hike. On December 19, the Bank of Japan expected to raise the rate by 25 basis points from 0.5% to 0.75%. This is a major issue because it's forced foreign investors who for the past 2 decades have borrowed at near zero rates with cheap money to invest in a risky asset like equities and the crypto to sell their holdings to repay these loans. This will trigger a massive global sell-offs across the stock markets, as these investors cannot simply refinance through US banks, and they borrowed cheaply in Japan and now cannot replace those loans at the higher rates in the US. As a result, is significant selling pressure across global markets. What we've learned in this cycle is very different from the previous ones. We have realized that macroeconomies must be studied, tracked, and analyzed in a depth. We have learned the right way to invest, and rather than assuming, like in the past cycles, that anything you bought would automatically rise, even the Popo coins. In this cycle, we've understood the importance of tracking more time for research before making investment decisions, and understanding and following liquidity flows and actively managing our risk. This experience has taught us that successful investing requires the patience, the analyzing, and the discipline, not just following the trends. If you like this video, please give the video a thumbs up and subscribe to the channel. Peace out.